Hello, it's me again. You knew that. Today I want to talk about the iron chicken. Now, you've probably heard of an iron condor if you've been around for long enough, and if you've been paying attention, if you know what an iron condor is, then go ahead and continue watching this video. If you don't have any idea what an iron condor is, you can go ahead and continue watching the video if you just want to hear me squawk for a while, but you're not going to understand a word I say. So go watch another video and don't waste your time here. But if you do know what an iron condor is, which, if you're a little rusty, I'll tell you, is selling a bear call spread and a bull put spread on the same stock with the same expiration, collecting that premium, and ideally getting to keep that money. I used to do these a lot. I don't know, it was probably a couple years ago, and I thought I was pretty good at it, probably because the market was going sideways, which is what you want when you sell these, right? Right. So the market went sideways for a while, and I was selling iron condors all over the place and doing okay. And then something happened. Something horrible happened. And the market started to go in some direction. I can't even remember which way it was going. It doesn't even matter. But it took me down hard. Because when these things go wrong, when an iron condor goes wrong, it goes really wrong because the risk to reward ratio is not really great, okay? The risk is really high and the reward is really small. So when they go south and you don't have a good risk management approach in place and that you actually do follow, you will get taken to the cleaners. And I did. I got taken to the cleaners. So what I did was I evaluated a bunch of my trades and I tried to figure out what went wrong. And in doing that, I discovered that I would have probably an 80 or 85% chance of a win if I followed certain rules. And those rules I have established, and they make the trade quite a bit safer. 85% success rate is pretty good, right? 85%, if you could get 85% of your trades right, holy moly, you're laughing all the way to the bank, right? As long as your winners are bigger than your losers. Yeah. Different topic. That's a different topic. I'll just say if you lose on 15% of your trades, 15% of your trades, but those losses are humongous compared to how much you win on your 85% of trades, you can still go broke. So yes, it is possible to go broke taking profits on 85% of your trades being wins. There, okay. Now, back to what I was saying. What was I saying? Oh, iron condors. So I went through and I figured out, how can I do this without losing my ass again and again and again? And I came up with some rules, and this is basically a safer version of the iron condor. So I have named it the iron chicken because it's an iron condor for chickens like me who don't want to lose their shirt again and their pants and their everything. So these are the rules. These are the rules of the iron chicken. It basically is the same thing as an iron condor, but with some caveats. First of all, when you want to do this, if you know iron condors, you already know you want to do this when the market is going sideways. Because if it's trending, it may take you down, and it'll take you down hard, as I already stated. So today is July 3rd, 2014, and I wanted to find a good example of a stock that might make a good iron condor today. And I remembered that eBay has been going sideways for quite some time, since about, let me check my chart here real quick. It looks like it's been going sideways since around October of 2013. So this back here is October of 13. And it's just been bouncing up and down. It's gotten as high as around 60. and it's gotten as low as about 48, and it closed today at $50.94. Now, when I'm looking for an iron chicken to sell, what I'm looking for is the front month. You can do it more than 1 month out, more than one expiration point out, but usually I like to do them pretty close in, like 3 or 4 weeks out, because otherwise things can just start to move, and when things start to move, you start to feel like you need to vomit. So I try to keep these things kind of close in time-wise, maybe 3 or 4 weeks again. Now, what I'm looking for with an iron chicken is I am looking for strike prices. I'm looking to sell strike prices that have a delta of about 0.12 or less. Okay? In the case of eBay, I checked, and the strike prices with deltas of 0.12 or lower are the $55 call, which is going for about 20 cents. That's the mid price. And the $47 put for July has a delta again of about 0.12, and it also is going for about 20 cents. So this is how I identify the options that I am going to sell. Okay. Now, these two are the ones I'm going to buy, so that when the stock does move, it doesn't completely destroy my whole life. It only destroys part of my life. So this is our protection. Okay, so usually what I do with a stock that is kind of on the pricey side, like a Google or something like that, is I'll use a $5 difference between strikes on the call side and a $5 difference between strikes on the put side. So in this case, if we're going to use a $5 spread between the strikes, then we would sell the 55 call, again with a delta of 0.12, and to protect ourselves in case the stock goes through the roof, I want to buy the $60 call. Now, when I do that, I'm going to get about 20 cents for the 55. That's money coming to me, and I'm going to pay 3 cents for the 60. So I'm going to get a credit of about 17 cents on that one. Now, the numbers just happen to be the same on the put side. Okay, the 47 put is the one with the 0.12 delta, and the $5 strike lower, which is the 42 put, has a delta of 0.01. The difference between those, again, the higher strike put is 20 cents. We're selling that one. We're buying the $42 put, which is 3 cents. So on the put side, we are also going to make a 17-cent credit per contract share. So the total here is, for this entire iron chicken, this is going to be a 34-cent credit trade. So we're going to make $34 minus commissions if the stock closes between 47 and 55. We have, given that the delta is usually a close approximation of the probability that the underlying stock will close on the expiration date in the money at that strike price, let me say that again, the probability that eBay will close at $55 or higher is about 12%, and the probability that eBay will close on July expiration at $47 or less, again, is about 12%. So we have about an 88% probability that this stock is going to close on July expiration between 47 and 55. And if it does that, we get to keep the $34. Okay? Here's a problem. 34 bucks is it's not much, right? $34. And what's your risk? Well, your risk is that the stock goes to $61. And then in that case, we are going to lose our risked amount, which is 60 minus 55, that's $5 per share, minus the amount of money that we got for the whole trade. So it's going to be the difference between the strikes, which is $5, minus 34 cents per share. So our total risk is $4.66 for the whole trade. Okay, we made the 34. We could lose $466. Now we have an 88% probability of success, but is that a risk you want to take? Do you want to risk $466 to make $34? I don't. Okay, this is not a trade I would take. There are a couple of other rules associated with an iron chicken that I want to go over too. One of those is I like to see at least 2, preferably 3, levels of support between the short put and the current stock price. And I also like to see 2 or 3 levels of resistance between the stock price and the short call. Now, what does that mean? That means if I am going to sell the $47 put, so I'm selling down here. Now, how many levels of support do I have between the current price, which is $50.94, and 47? Well, I have one level of support right here at about 48, right? Because that's where it found support before. It's liable to find support there again. So that's one. Are there any other ones? I don't see any. So in this case, I would not take this trade. Even if the $34 was higher, if it was, say, $1, if it was $1, then my risk would be $400. And I would still not take that trade because there's no support in here. If it loses $48, it can very easily go to 47. So, a better thing would be if the stock was, it went up and then it went down and it bounced off of 50 and then it went up again. Then we would have a couple levels of support in there. And the chances of it going down to 47 just purely based on support would be a little less. Less likely to go down to 47. Now, it's the same with resistance. In this case, we want to sell the call at 55, so that's up in here somewhere. Now, looking at the chart, let me just check. I don't have all the numbers in here, but it looks like the highs have been mostly around 56. This area in here, this is about 56. There may have been one bounce in here that was below 55. So what I'm seeing, that's a terrible 5-6. Let me do that over. 5, 6. Okay, so most of these are right around 56. So I want to sell the 55 because that's the one with the 0.2 delta. But what's going to keep this from going $50, from $50.94 up to 55 or above 55? Because, as soon as it goes above 55, your trade's in danger. Okay? If it goes above $55 and 34 cents, you're going to start losing money. So, you know, again, ideally, these peaks would be closer to, you know, 52. If they were at 52 and our strike price that we're selling is $3 above that, then I would be a little more comfortable selling that iron chicken. You could still sell the iron condor, but don't call it a chicken because it's not a chicken. Okay, these are the rules. These are the chicken rules. Number one, where's my eraser? The rules of an iron chicken then are, I'm going to erase this and pray that I'm not sorry later, because I don't want to have to look it all up again and my memory's horrible. Okay, so the rules of an iron chicken are that, number one, your short options, both the put and the call, have a delta less than or equal to 0.12. Okay, that is a rule. That is a rule. That's a rule. You've got to follow that rule. If you're going to call this an iron chicken, your deltas better be less than or equal to 12 on your short options. Okay. Number two, at a minimum 2, preferably 3 levels of support and resistance between your short strikes and your current stock price. Current stock price. Now again, these rules, they're based on a review that I did of tens of trades. Okay, I looked at all this stuff. I looked at the deltas, I looked at the days to expiration, and I figured out what these rules would have to be to give me the highest probability of success. So these rules are not just, you know, I didn't just pull these out of the air. I studied and tried to figure out what would keep me from losing my ass again and again and again and again and again on these damn iron condors. Okay, so those are 2 of the rules. Now the third rule is, this one might be confusing, is that you need a minimum of 1 ATR from the stock price per week to expiration. What the heck did I just say? Well, let's look at this. The ATR for eBay, the 14-day ATR, right now is 60 cents. I looked this up before I started recording. I didn't just make that up. That's for real. Really. Okay, so 60 cents. Now, if I look at the option chain, then I see that we have, let's see, today's July 3rd, so the expiration date is 15 days from now. It's a little bit over 2 weeks out. I'm just going to go ahead and round to 2 weeks, okay? So what I do is I multiply that 14-day ATR by the number of weeks to expiration. In this case, it's 2. And what I get is $1.20. Now, what am I going to do with that? Well, what I want to do is to make sure that my current stock price is at least that far away from the options that I'm selling. Okay, so I'm going to sell the 48. I'm selling the 48 and I'm selling the 55. Now if we do the quick math here, to get from 50.94 to 55, crap, I hate math. Where's my calculator? I know, I can do this in my head. I really can. I could even do it on the whiteboard, but when I'm being recorded, my brain just, I don't know, I don't trust it. So 55 minus 50.94 gives me $4.06. So it has to move $4.06 from where it is right now to get up to the short strike for the call. That's the call, and that's the put. Okay. How many ATRs is that? Well, if we divide by 60, then we get, I can do this. I can. I know I can. 406 divided by 60 cents is 6.7. That's 6.7 ATRs, okay? 6.7 ATRs. Now, we only need it to be 1 ATR per week away at a minimum. So right now the price is 6.7 ATRs away, so we're fine. We're fine on that. That rule is met for the calls. Let's see if that rule is met for the puts. So we're selling the 48. We're selling the 48. The current price is 50.94. So how far is that away? That is $2.94 away. Is that more than 1 ATR per week to expiration? Yeah, because 1 ATR per week to expiration is $1.20. There, see, $1.20. Sorry about the glare. Okay, it's more than $1.20. 1.20. So since that's more than $1.20, more than 1 ATR from the current stock price to the short strike per week to expiration, that rule is met. This rule is met because those are the short strikes that we looked at, the ones with the delta of 0.12. This rule is not met though. We don't have 2 or 3 levels of support and resistance between the current stock price and the short put strike and the short call strike. Is that making sense? I want this price to stop and turn around before it hits 48 or 55. And if I've got no support between the current stock price and 48, which is the short put strike, what's to stop it from going all the way down there? Nothing. So it would be stupid to sell it because it's probably going to do that in 2 weeks. Maybe. Maybe not, but don't be crazy. Don't be crazy. I mean, these rules, listen, these rules are rules because they work. All right? They work. Now, this particular trade, I wouldn't do it because it doesn't meet that requirement. There's no support and resistance to keep this stock price from going up through the call that we sold or for going down through the put that we sold. So, I already know that this trade is a no-go. But let's assume it is. Just for fun, let's assume that it meets all of the rules and that we go ahead and take the trade, which would be really absurd because, really, you would sell an iron chicken for 34 cents and risk $4.66? No. I mean, this trade doesn't even make sense from the get-go, really. And I tell you another thing. Hunting the iron chicken is a challenge. It can be a real challenge. These are not easy to find. If they were easy to find, I'd just be doing them all day long. And it's a pain in the ass to find things that actually have a decent reward to risk ratio following these rules. Now, to me, a decent reward to risk ratio is And this is just typical. This is what I found to be a decent trade. Usually I want to get $1 credit on an iron chicken if the difference between the strikes is $5. And that means between the short and the long options. Okay. If I can get $1 on a $5 strike difference between the two puts, the one I'm selling and the one I'm buying, or the call that I'm selling and the call that I'm buying, and everything else looks good, then I'll take the trade. If it's less than $1, kind of depends on what the overall market's doing. It really does depend on support and resistance. I mean, you don't want to take a risk on these things. It's just, man, they'll kick you in the teeth. See, I don't know if you've watched my kindergarten videos or my preschool videos. I can't even remember what I call them, preschool. I keep telling people, don't trade. Don't do it, because you're going to lose your ass. You know, you can lose your ass on an iron chicken. Even. Okay, so I'm going to tell you, so you don't lose your ass on an iron chicken, I'm going to tell you when to get out. All right? Your stop is the short strike. Whoops, the short strike, that means the one you sold. In the case of the call, it is going to be minus the ATR. And it's going to be the short strike plus the ATR for the put. Now, what does that mean? Well, on the call, we sold the 55. And what was our ATR? Do you remember? I remember, miraculously. It was 60 cents. 60 cents. So here's the deal. If this stock price, which is currently $50.94, moves up to within 1 ATR of the short call strike, close the freaking trade. I don't care what you think it's doing next. Close the freaking trade. I don't care if it looks like it's about to roll over. Close the freaking trade. Okay, are you hearing me? Close the trade. Buy to close. Buy to close the call spread. Okay, you don't necessarily have to buy to close the put spread, but definitely you want to buy to close the call spread. So if this stock price gets up to $54.40, then you buy to close the bear call spread. Okay? Please buy to close the bear call spread if it gets within 1 ATR of the short strike, or you'll be sorry. You will be. You'll be sorry. You'll do it. You'll think you're clever, and you'll think the stock is just about to roll over because the MACD is too high and the stochastic's up there. Well, you know what? I don't care. Close your freaking trade, okay? Buy to close, buy to close. Okay, now if the price goes within 1 ATR of the short put, which is 48, the price getting within that would mean we're adding that ATR. So in this case, if the strike price goes down to $48.60 or less, buy to close the bull put spread. Again, you don't have to buy to close the call spread. You can leave that up there. You know, that one might still be okay. I know that doesn't look anything like the word spread. I'm going to redo it. Okay? So look, this is to keep you safe, okay? Because your reward to risk on this is still, even if you get $1, even if we did get $1 on this trade per share, that's still a pretty big risk. You're risking $400 to make $100. Okay, if your stock price gets within 1 ATR of your short strike, just cut and run. I'm begging you, please, 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 just cut and run. Don't wait for it to bounce, because you know what? The market loves to kick you in the teeth. It does. It does it every freaking chance it gets. So don't let that happen, all right? Don't do it. Close the trade. You will not be sorry. If you hold on to this, you may lose $400. And for what? So you can say, hey, I was right. Don't be crazy. Don't be crazy. Don't. Trading is for crazy people. All right. I can't think of anything else. Those are the rules. Delta of 1.2 or less. At least 2 or 3 levels of support and or resistance. No, both actually. You need support and resistance. You need support below and resistance above between the current stock price and your short strike. And at least 1 ATR away from the current stock price per week to expiration. Okay? All right. That's it. Good luck. Really, I mean, I really do mean that. I really do. I really hope you have good luck. I hope you make a lot of money. I wish everybody would just make a crap load of money out of this market because, you know, it took enough of mine that somebody ought to be making it besides the freaking market makers. Okay. Not that I have a problem with market makers. I mean, they've got to make their money too, but that's all. See you next time.